Let's talk market fundamentals, and to do that, Dhiraj Sachdev, Senior Vice President and Fund Manager Equities with HSBC Asset Management, joins us live. Dhiraj, good to have you back and thank you for joining us. Dhiraj, it's been a foggy start to 2014 and the euphoria from 2013 has not rolled over to 2014. I know these are early days, but the start is not very promising.
Yeah, good morning, Nikunj. I think it will be wrong to conclude only from the index, because the broader market and some of the ideas and stocks which are outside the index is still participating. So if you actually see the mid cap and some of the cyclical stocks have rallied despite not so strong performance over the last few days from the index per se. But having said that, Nikunj, while it may not appear to be a good start, we are fairly constructive and positive on the markets over the next 12 to 18 months. And I think the way we look at it over the next 12 months is, while election is a key event, the market behavior will be divided into two parts. One is before the elections, where the market will have exaggerated hope rallies on the expectation of a stable government, which itself is uncertain. So there will be corrections of these exaggerated hope rallies. Also, some of the domestic cap goods and cyclicals have run up ahead of time, with earnings not supportive enough in the near term. So there will be, those kind of corrections of these hope rallies. But post-elections, if assuming a stable and decisive government comes into power, then you will see more kind of a sustained rally. So one is the election clearly is a influencing factor in the market over the next 12 months. Second is at the margin, fundamentally speaking, we are seeing positive and early signals of macro issues receding. Whether you talk about a relatively better GDP growth number of 4.8% in the second quarter, though it is still far off from the 6 to 7% number that we used to talk about, or improving CAD number where it had all the noises last year, and even better or stable currency environment, forex reserves, etc. So at the margin, these things are improving on the macro side. We're also witnessing some rational decision making on the power tariffs, etc., or efforts being made to eliminate the hurdles on industrial or capex cycle, etc., whether it is coal linkage issues or some of the other hurdles on the investment cycle. So these are the things that is happening, though still the recovery at the ground level is far off. On the other thing is that the central banker has been pro-growth and managed to hold the rate so far, assuming that the food inflation will ease out over the next few months. So at net, all these pieces together makes us believe that it can be a buy on dips market and one has to stay positive. Compared to last year, where the market was fairly polarized on the IT and pharma side,
right,
this year we would actually witness a more broader participation of the market, where the mid caps on improving sentiment of the market, or even some of the cyclical sectors, be it autos, banks, or even capital goods, will have a kind of gradual recovery.
Dhiraj, in the near term though, what's a little concerning is that the FII activity has fairly slowed down and inflows have somewhat been petering down. Yesterday as well, it was a sell figure both on index futures as well as FII cash, or rather cash markets. What's the sense that you're getting? Do you think this is going to be a trend for all of January because there are important events lined out? You've got the earnings season as well as the RBI policy, or do you think this is just a one-off aberration?
It could be an aberration. We can't conclude the trends based on the last few days. Remember last year, in a very difficult economic environment, they pumped in almost close to $20 billion. And we have received close to $70 billion in the last 3.5 years. So FII's long-term view and biasness on the emerging markets, including India, remains fairly positive. So we cannot conclude their elimination or running off from the emerging markets or countries like India.
Dhiraj, but if global growth makes a genuine comeback in 2014, the fact that global money was coming into India because global growth was a concern, do you think inflows could become outflows? Because for foreigners, if their back home market is doing better than emerging market, why would they invest into India?
Nikon, the taper and yield improvement in developed markets has always been a noise and issue, but honestly speaking, the asset allocation profile of the mature, foreign investors who have still skewed asset allocation in investing in countries, whether it is US, Japan, Europe, etc., is fairly high. So relatively, asset allocation is changing towards emerging markets given better relative growth, or maybe moderating of inflation over a period of time, or growth resuming back. So we don't expect the change in trend. The asset allocation will still be tilted towards these economies, given better relative growth, very naturally, rather than pumping of artificial money.
Dhiraj, Axis Bank lost another almost 2%, and this has been the 5th successive day of red that the stock has seen. Is there a whole lot of concern about the government selling the Sooty stake?
Actually, I cannot comment on stock specifics, but the fact is that we still like some of the private sector banks, given that over a period of time they have shown resilience in asset quality vis-a-vis the public sector banks, and relatively they are able to capture market share, whether in terms of CASA deposits or lending business, etc., vis-a-vis the old generation private or public sector banks. So it could be part of the market correction, but net, if we believe that the economy growth will be gradual in nature, some of these private sector banks which have very heavy balance sheet on the corporate lending side should also show improvement in the earnings growth.
For the moment, the consensus call on D Street is that economically 2014 will be a much better year for Indian economy. But somewhere do you think the growth assumptions are looking slightly stretched, because the key data points, be it the IP data, inflation or auto dispatch numbers, they're still floundering, unfortunately?
You're right, Nikunj. I think at the ground level, we still believe that the recovery may be back-ended, and the investment cycle is, whether it's a new project announcement, etc., is far lower than what it used to be. So while you may have seen capital goods stocks rally in anticipation of resumption of investment cycle, but it could be fairly back-ended, and there could be disappointment in the earnings. On the auto side, we are still tilted towards and positively biased on the consumer side, be it two-wheelers or cars, and we have still not seen any kind of a meaningful recovery on the commercial vehicle side. So yes, to that extent, it appears to be stretched, and it could be back-ended.
Dhiraj, what's the sense that you're getting about the IT earnings this time around? Because a lot of eyebrows have been raised, given the way Infi has actually started off this earnings week, down for 2 consecutive days. Do you sense that perhaps it would be a weak quarter, as traditionally it is, from the entire IT basket?
Seasonally, December quarter is generally weak, given the larger number of holidays due to festive season in US. But the fact is that US recovery augurs well for the IT sector. We are seeing renewed growth guidances from many companies in the sector, and we believe this earnings growth momentum should sustain for larger companies and many select mid-cap IT companies. So we are not negative on the IT. It's a fairly capital efficient business. We are seeing stabilization of margins at the company level, even on the large companies, and we are not seeing any change in trend in the US demand environment. In fact, it is only on the rise.
Dhiraj, one of your core portfolio position is autos. Why are you still bullish on auto? Because auto dispatch numbers are clearly indicating that there is a big slowdown in the entire two-wheeler sector and the four-wheeler sector as well.
Nikon, we are taking a view that if the interest rate cycles eventually will moderate, then auto being the interest sensitive sector, we are still biased more on the consumer side of auto side, which is passenger vehicles or two-wheelers or cars, rather than the industrial side of commercial vehicles. That's on the large cap positioning. On the mid cap, we are fairly positive on the auto ancillaries, which include tire companies which have better replacement demand, or may see margin expansion because of favorable raw material rubber prices. So those are some of the specific calls in the auto ancillary side.
What about pharma, Dhiraj? Because at a time when the market is somewhat struggling to even hold 6150. You've had the pharma index hit in lifetime high. What is it that you like out of the pharma space?
Aisha, pharma, what is again, evident is that new product launches in the US generic side of the business is fairly strong, and many companies are actually entrenching, bigger outsourcing of the molecules or products, whether it is para 4 or some of the para 3 products or complex molecules. So you might actually see greater predictability and visibility in terms of earnings growth from many pharma companies. Again, US recovery, greater outsourcing, and will sustain the momentum for pharma earnings. Again, the business is very similar to IT in terms of capital efficiency, high ROEs, and better earnings growth. So the sustainability of earnings growth and capital efficiency makes it a core holding in many portfolios for the long term.
Dhiraj, there is a very old maxim on Wall Street, which is that in markets, courses remain the same, horses they change. So if we are on the threshold of a new bull market, which sector, which group, or which particular theme do you think will be the next leader for the bull market?
Nikunj, as I mentioned earlier, last year we saw a fairly bipolarized market where only IT and pharma did well and the rest were completely ignored. But this time you might actually see the rest of the pack also coming back in terms of mean reversion, because the valuation gap between the so-called defensive IT pharma and the other sectors has only widened. Though of late it has started to recover. But we believe mid-caps, can do well in a improving sentiment of the market. We may also see some of the cyclicals like auto ancillary or banking or cement and capital goods eventually, though back-end it can come back in terms of better pricing environment and growth. Agrochemicals is doing extremely well thanks to better monsoon. Again, the character of an agrochemical business is very similar to pharmaceutical, very high capital efficiency, very solid earnings growth, which can be sustained going forward over a period of many years. So we like that these pockets of investment in the mid-caps.
Dhiraj, does media as a pocket interest you? Because of late one has seen quite a bit of up move coming in both exhibition as well as distribution stocks.
Yeah, media can actually be a investment pocket, but only thing is that we don't have many listed companies. MSOs are still bleeding because there is a heavy upfront investment in putting up set of boxes at the the consumer homes, so they will require heavy dose of capital in the initial period before the returns fructify meaningfully. DTH could be one of the interesting pack for the long term. So, and the content business. So yes, media could be an interesting play, though the business models are fairly different across the segment or the value chain.
So you've given me a flavor of structurally which are the businesses and which are the group of stocks you're bullish on. But tactically, how are you positioning your portfolio? Tactically, what are you buying where you see a 15-20% upside?
We still are biased towards the mid-caps. We believe mid-cap valuations are still far lower than their large cap counterparts, and there are very interesting ideas and sectors, whether it is agrochemicals or tires or mid-cap IT companies or mid-cap pharmaceutical companies. So these 3 or 4 sector pockets are where we are concentrated heavily on.
Percentage of your total capital, how much have you allocated to mid-caps? And when I say mid-caps, a very crude definition here, anything which is outside Nifty 50.
Well, in the mid-cap fund, everything is outside Nifty 50, so almost 100% of the mid-cap portfolio is invested in mid-cap stocks.
No, but you also have a large-cap fund, equity diversified scheme. In that, how much exposure do you have to mid-caps?
So we are inching closer to almost 30-35% in the mid-cap, even large-cap fund. But these are larger mid-cap stocks, which could be, anything about 3,000 to 5,000 crore as well.
And as percentage of your total portfolio, how much have you allocated in IT and how much have you allocated in cyclicals?
I may not have the specific figure, but we are overweight on IT, as I mentioned, because the capital cost or interest cost is still pretty high. So these are capital efficient businesses, and we like the US growth momentum which will be sustained over the next few quarters as well. So we are overweight compared to the benchmark on the IT side. Cyclicals we are gradually adding up because we still believe that the recovery will be back-ended in cyclicals. At the ground level, investment cycle has not really picked up, though the hurdles of executing the stuck projects is happening. So we are at the margin increasing our weightage gradually in cyclical stocks.
Final question, why do you think the market euphoria in mid-cap will not end in disappointment? Because I'm with you when you say mid-cap stocks are looking cheap, they've done nothing in the last 5 years, they've been in the longest bear market I have seen them in, but what about growth? What about earnings? There is no evidence of any kind of an earning pickup or growth built up.
Nikunj, you're right in terms of mid-cap as a segment was in prolonged period of hibernation, and the absence of retail investors also contributed to that, and FI money was largely focused on the large caps. But as the sentiment improves, historically it is proved that the second and the third stages of market rally also recognizes mid caps and small caps which are beaten down. And some of the mid-cap companies were trading just 3 months back as low as 4 times to 5 times price to earnings multiple, 0.3 times price to book, dividend yields ranging from 5 to 8%, and that is what is getting corrected. We still will have a long way to go, but the basket will have frenziness and corrections. That will be part and parcel of the mid-cap peculiarity as a segment. But the fact is that as the sentiment of the market improves, you will see the recognition of mid-caps coming back, and that's why we like it.
Okay, Dhiraj, good chatting with you. Really appreciate you taking the time out and speaking with us.